Go ahead and get started. Welcome everybody. This is Ken Long at Tortoise Capital with a review of the weekly trading plan for October 27th, 2012. We have a market that is bullish normal, although we're getting very close to the sideways. On an annual basis, using weekly RSI 14, about 55 out of 100, so just slightly above the midpoint. On the 10-day index, we are in the red at oversold conditions with 13 out of 100. Percent stretch compared to the 200-day moving average, we are in red, bullish at 3.29%, so we have only 1.3% cushion between us and the what little is left of the bull. So 1.29% cushion to the 2% threshold above the 200-day moving average. Slope of the 50 is at yellow neutral at 0.05%, so it's basically flat and weak. ADX has pulled back to 19.2, which is neutral, no trend. Bears are in charge, excuse me. And ATR percentage has crept up to 1.09%, so above average and normal. The blended monthly is still holding energy, gold, and Asia less Japan in the 26 ETF portfolio. 13 ETF portfolio is Australia, Asia less Japan, and technology, with the next reevaluation being done on or about Thursday on 1 November. So those of you, trying to get that leg up on it, looking around Monday for to make your changes. In ETF2, the theoretical exposure at 8%. I'm recommending that we sell DIA and then one position of IBB. Biotechs were the big loser for that week, and although it had made money for us, it's starting to give that back. Looked like the market had cracked. Model portfolio will be at 80% exposed after the two sales, as is the theoretical exposure. It wouldn't hurt my feelings if you sold both helpings of IBB for a win and kept DIA, but that's what the numbers look like to me. Moving on. All right, looking at the 13 ETF portfolio, we have 4 of them that are on a cash position. It's the long-term treasuries, real estate, Japan, and the NASDAQ. Remember, 2 of those 4 were the highest winners there just a couple, 3 weeks ago with technology and U.S. real estate. So everything cycles. The winners are Asia less Japan, Australia, and the Euro-Asia blend, followed by emerging markets. So it's the first time in a while we haven't seen one of the U.S. Indexes in the top 4. Yeah, among the U.S., the small caps, then the large cap. Looking at the 26 ETF portfolio, it's more of the same. Really, it's just leading the way. Asia less Japan, financials, China. And China had been, even 4 weeks ago, China was just horrible, along with India. And yet every dog has its day, and you can read the rest of them there. So definitely sector cycling is going on here. Next up, looking at the market health check. So the vertical blue lines are 10, 20, and 30 days worth of look back. Horizontal purple line, still 147 and some change, is still is now held for 4 pushes higher. It pushed higher in September, and then redid in October and rejected here in late October with a lower high each time. Horizontal red lines are previous support levels that have held. You see the one at 142.5 cracked and now is acting as resistance right now. The solid line and shaded red area is the 200-day moving average, and the boundary for sideways is 2% above that. So right about 140-ish, 139-ish in that area. This last solid red line is the boundary to today's market. The 2 big white candles that pushed us up into this green zone that was the ECB and the Fed announcements. Other than that, we've had really almost 40 days of just sideways chop. You can see even the 10 period moving average has rolled over. The river is starting to roll over. In fact, the Bollinger Band mean in the river has rolled over now. The regression line is the solid black line in the middle. That's the slope is downward. The outer black lines form the channel based on the maximum excursion from the regression line during the look-back period, which hit on the two previous swing highs. And then the solid blue lines are a projection of that regression channel forward, showing what the normal path would be. The shaded rectangle, 5 and 10% pullbacks from the previous swing high. 0 to 5% would be considered noise. So if we break below 139, that's going to be simultaneously a breakdown of the regression channel and this last level of support from the previous yellow sideways choppy area. And it'll put us into sideways condition based on price relative to the 200. And then that's sort of, in my view, the last firewall that's protecting this choppy bull that's been moving up. On the positive side, we still are in a bull market that has been oversold for a couple days, and has found support here at 141. And so the last time it did that, you can see just a couple weeks ago, there was about a 3% bounce, and before that another 3% bounce. So breaking above 142 here should take it back to the Bollinger Band need about 145, but that's pretty soup for those trying to make the case for the bull market to resume. Really, until it gets above 147, this will look like an intermediate top that has slowed over as we drift into the election, which will be on or about the 6th of November out here, another week. And that's going to be a big sea change. So as we have been talking about for the last 6 or 7 weeks, this no runaway bull until that political tension is resolved, and then the $500 billion sequestration tension has got to be resolved. So we'll see how that goes. PPO reliably got those jaws pointing downwards, pointing the way lower. ADX down below 20. You can see the bears are in charge. So not a healthy market by any means, but reasonably postured here just above the 200 while the market pauses and waits to see the political tension resolve itself. And I think that's sort of the reason for strength in Europe has been they've weathered their storm 3 or 4 months ago. They haven't melted down. They're a safe haven while the U.S. sorts out the election. At that point, the U.S. market could very well be poised for resumption. If we get Romney, that'd be the conventional wisdom. If you get Obama, then all bets are off. Although from what I've seen right now, it looks like a Republican House no matter what. So at a minimum, we get gridlock. So if Obama wins, we get continued gridlock for another 2 years. That's actually good for the market. And then I would expect to see a recovery relief rally there. Especially if Obama wins, the Republicans keep the House, and sequestration passes, that cuts almost $1 trillion out of the bloated budget. So that would actually be interpreted as good news, I think. So if Obama wins, I think it's going up. Moving on, we have the ETF2 summary here. We got 2 of the 10 regional indexes are in a cash. That keeps us at 80 and 20 invested in cash in the theoretical model. That should read bold normal, excuse me. EFA right now at 58 is better than, and 66 I judge is slightly better than S&P at 59 and 60, giving a little more strength or credence to the strength column. It just looks stronger. The 2 strongest, definitely IEV at 62 and 70, and then EPP at 63, and then also green and consistency. So it's the overseas markets right now they're working. Inside the U.S., it's SPY, the Qs, and then about a toss between the mid caps and small caps. If you look at it from the pure strength, then still the S&P is still slightly above. 2 weakest remain Latin America and Japan, as has been for a long while. So the torch has been passed over to Europe, but I think that's postured to change once we get the election results. Same story with the world market model. That's everything Europe and most everything Asia, less Japan, is above average. Even Canada and Mexico are joining the game and are better than the U.S. The only thing working in the U.S. is a little bit S&P and some of the value plays. Silver and gold looking good. And then this energy and finance complex doing better than even the defensive plays of utilities and healthcare. So that's sort of an anomaly here. The top 30 in the ETF2 database. Home construction, sovereign debt, emerging markets. Spain, who'd have thunk Spain would be at the top of the list? Moving on. The dogs come in from the outside and hi. Package girls. Start with the Dow 30 through the same lens. And what we have here is financial sector, Bank of America and Travelers, followed by the old reliable Home Depot, Walmart, Pfizer, Merck, Procter & Gamble. At the bottom of the list remain the troubled Hewlett-Packard, Intel, DuPont, Caterpillar, Microsoft, and even Health. By liquidity is the next target. We're looking at next reference data. The VIX is back above 4% on increasing volatility here. Russell small caps continue to dominate the Qs as the trading vehicle of choice with almost 50% more volume, and now only 1/5 behind the S&P. Looking at the regression line crossovers of 4 markets, you can see the equities have failed here, have failed out of the river in both the S&P and the small caps. Gold has pulled back, but has started to find support here at that 165 level after a nice run up. Treasuries stabilized down here around, found support again around 120, and are postured for a nice little run on the risk-off trade in the U.S. So I think right now that channel between 120 and 130 continues to be attractive on a swing basis for Treasuries. We'll zoom ahead now to the to daily. All right, so we got some overreaction in chances in the SPY and diamonds, and then channeling for SPY, the NASDAQ Russell. Let's see. You see the increase in volatility here continues. It's now up above almost is 1.09%, right back to the middle of the 6-month look back. Reasonable pattern trades are developing. Give you a little more. Pattern trades are handling overreaction. A lot of the large caps. We have some triple screens available in JP Morgan, Pfizer, Merck, Verizon, 551W, and Merck. I think that's aligned with that healthcare value play, and a lot of positions here in the auto framer. This is a target-rich environment when we look at the Dow Tactical. Lots of dojis, lots of channeling and overreaction, a handle triple screens, and a 551W. And then just take a look at the max pain range compression candidates. 9-to-1 ratio in DuPont, almost 7-to-1 in IBM, and 6-to-1 in McDonald's. So we'll take a look at those a little bit later. Quite a large number that finished on Friday. So the RSI 2 readings, anytime it's under 5, that would be very attractive. McDonald's to me will look interesting at a 6.3 auto framer and an RSI 2 value of 3, and General Electric at 1, Bank of America at 4, Boeing and Disney at 1, 2. So quite a few symbols that are postured for 6 just on a trade location basis. So we'll take a look at DuPont and McDonald's for sure. Same logic in the ETFs and almost the same kind of spread. You'll notice that almost everything in the stack tests out better than 2 to 1. So this is a target-rich environment for our trading. Handful of dojis here with Europe, Eurasia blend. Coal is at 2.4. Go all the way up to oil, mixed commodities, natural gas, S&P. The S&P is at 3.5 to 1 on a reward to basis. Brazil at 2.2. That's a favored trading target. U.S. real estate is channeling in an overreaction. Auto frames at 2.6 and has an RSI 2 value of 3. So that has some potential as well. So take your pick for your favorite target. You'll be able to frame some interesting trades here. Next up, market mosaic. See, paints a pretty clear picture that's been developing over the last 2 to 3 weeks of the weakness, just getting weaker. Notice how the regression line crossover back here when price was up around 147, that regression line alerted us to potential downside weakness, and here it comes. You can see the failure here on the slip of the regression line, how it's come back below average, below the 0 line, and now you can see that the slope value is below the dashed red line, and that means it's now a negative slope, which you can see over here in the northwest corner. Percent stretch has pulled now 1 full standard deviation below average. Next stop, a couple percent away, is that 200-day moving average. So definitely weakness in the market rolling over here. The z-scores of the regression lines. That was a pretty good early warning signal that the 90 got as steep as at more than 1 standard deviation on the z-score, favorable, and couldn't hold. It rolled over. 30 has rolled over. The 10 rolled over 3 times, making lower highs, and now is run away down outside of the river, steep down. You can see on the 10 period regression compared to price how it's sailed out of the river. And found some stability here around 141. But it's got a hold right here. But you see how the river is starting to get wider and the river itself is rolling over. The last time it did that, there was another almost an 8% fail from this location back at the last that it bent and rolled over. So that was the last time it checked the 200-day moving average. So that there's another 5% suggested as a potential downside. That's everything I want to look at on the weekend reports, the structured reports. The other ones are in there for your reference, of course. I would like to look at the, let's just take a look at, I want to look at DuPont. Let's see, there we go. Okay, so showing DuPont now. I will explain the 10 to 1 reward to risk ratio, the bail, finding support at 45, and a measured move back to 46.5. If it gets there, the next target would be closing the gap at 48.5. So that has possibilities. I wanted to look at, I think it was Microsoft. A quick look there. Microsoft found support here around 28, has held support 5 days in a row. Just a return to the last support level gives favorable reward to risk. We'll take a look at treasuries. Found support at the 200-day moving average around 120. If it breaks through 125, then it's on to 127. And then 130. So I'd be that this is a profit target This is a profit target 127, and otherwise 130 up in here. And with the measured support level here, that gives you a very favorable upside potential in Treasury. Definite risk-off trade, but that looks attractive. Take a quick look at gold. Take enough. I might try careful. I like this pattern in gold right here. It's had a really nice run up to 174. Has had an early pullback to the, and if you play word here, you have a nice reward to risk ratio. This looks attractive here with that kind of reward with support here. But here,
that's a really attractive move right there. Just, I don't like tonight. Lots of big red move, big M's in here. Overnight gap is just brutal fight to earn during the day can disappear. A Kansas City get together around 30th next year. I think Mark McDowell this week I was not there, and my team killed for me in next quarter. Sort of feel like February-ish. February can still mention what there is. Yeah, just to repeat, as some bad connection here. We're looking to potentially get together in Kansas City in February. And we'll see